You're 22, standing on a trading floor for the first time. The noise hits you before anything else. 300 people talking simultaneously, phones ringing, Bloomberg terminals flashing red and green, someone across the floor screaming a number into a headset, the smell of coffee and adrenaline, and something that might be fear. Your desk has 6 monitors. You have never seen 6 monitors on one desk before. The trader next to you, a 3-4 year old named Marcus who has been doing this for 12 years, does not look up when you sit down. He is watching 3 screens simultaneously and typing with one hand while talking into a headset with the other. He will teach you everything worth knowing in this building, or he will ignore you completely for 6 months until you prove you deserve his attention. Both outcomes are equally likely. 14 years later, you are sitting in a glass office overlooking that same trading floor. Your book, the portfolio of positions you are responsible for, is $50 million. Last year, you made $8.3 million in personal compensation. Between that first desk and that glass office sits a path where 70% of junior traders wash out in under 3 years, where one bad quarter can end a career that took a decade to build, where the market does not care about your feelings, your mortgage, your family, or your talent. The market only cares about your profit and loss. This is every level of becoming a Wall Street trader in America. What it pays, what it costs, and what nobody tells you before you sit down at those 6 monitors. If you want to know what each level actually looks like when you are standing in it, subscribe. New breakdown every Saturday. Level 1, the desk analyst. Age 22 to 24. You got here because you went to the right school and interviewed correctly. Target schools for trading desks: University of Pennsylvania, NYU Stern, University of Michigan, Cornell, Columbia. Your GPA was 3.7 in finance and economics. You networked aggressively, 280 LinkedIn messages over 18 months, 12 coffee meetings, 3 informational interviews, 1 super day at a bulge bracket bank on a Tuesday in October. You got the offer on Thursday. Your title is Analyst. Your base salary is $85,000 to $100,000 depending on the bank and desk. Your year-end bonus for year 1, $20,000 to $50,000 depending on desk performance and your individual contribution. Total first-year compensation, $105,000 to $150,000. Your job is not to trade. Your job is to support the traders. You run risk reports. You build spreadsheets that track positions. You monitor market data and flag anomalies. You answer the phone when the trader is busy. You make sure the Bloomberg terminal is set up correctly before anyone arrives. You arrive at 5:30 a.m. The market opens at 9:30. You do not leave until the traders leave. The traders leave when the work is done. Sometimes the work is done at 6 p.m. Sometimes it is done at 10 p.m. You do not have a schedule. You have availability. Marcus finally speaks to you on day 47. He asks you to pull the correlation matrix on a basket of energy stocks he is building a position around. He wants it in 20 minutes. You deliver it in 14. He looks at it for 30 seconds. He says, "Good. Now tell me what's wrong with it." You look at it again. You find the error. A weighting calculation that skews the output by 3.2%. You correct it and hand it back. He looks at the correction. He nods. That is the beginning of your education. Level 2, the junior trader. Age 24 to 27. You passed your Series 7 and Series 63 licenses, $300 in exam fees. 6 weeks of studying on nights and weekends while still working 6 zero-hour weeks. You are now allowed to execute trades, not to manage positions, not to make decisions about what to buy or sell, to execute, to take an order from a senior trader and put it into the market efficiently. Best execution, minimal market impact, no mistakes. Your base salary, $120,000 to $150,000. Your bonus potential, $75,000 to $200,000, depending on desk performance. Total compensation in a good year, $200,000 to $350,000. You are learning to read the market the way a doctor reads an EKG. Price action, volume, order flow, the relationship between the equity market and the options market and the futures market and the bond market, how news moves prices, and how prices move before news. Marcus gives you a small allocation, $500,000, a real position, real money, real risk. You are long a pharmaceutical company ahead of an FDA decision. The FDA rejects the application. The stock drops 34% in 11 minutes. You lose $68,000 in 11 minutes. Marcus watches the whole thing from his desk without moving. After the position is closed, he walks over. He says, "What did you do wrong?" You say, "I held too long. I should have had a stop." He says, "No, you sized wrong. The stop doesn't matter if the size is wrong. You never put 13% of a small allocation into a binary event. Ever. You write it on a post-it note and stick it to your monitor. It stays there for 4 years. A junior trader named Kevin on the desk next to you blows up a $200,000 allocation in a single session chasing a meme stock. He is gone by Friday. His desk is clean by Monday morning. You think about Kevin every time you feel the urge to chase. Level 3. The trader. Age 27 to 32. You have your own book. $5 million to start. Real capital. Real profit and loss responsibility. If you make money, the desk makes money. If you lose money, the conversation with your manager is immediate and uncomfortable. Your base salary, $175,000 to $225,000. Your bonus, a percentage of your profit and loss, typically 8% to 15% of profits, generated above a hurdle rate. Good year. You generate $1.8 million in profit and loss. Your cut at 10%, $180,000. Total compensation, $355,000 to $405,000. Bad year. You generate negative profit and loss. Your bonus is 0. And the conversation about whether your book continues is very real. You specialize in equity derivatives, options, volatility, the relationship between implied volatility and realized volatility, and the opportunities that open when they diverge. This is a discipline that takes 3 years to understand at a surface level and 10 years to understand deeply. You are at year 2. Your risk limits: maximum position size, 8% of book, maximum daily loss, $75,000 before mandatory review, maximum drawdown, 12% before book is reduced. You hit the daily loss limit on a Thursday in February. A position goes against you on unexpected economic data. You are down $74,800 at 3:15 p.m. You close everything. You write the loss report at 4:30. Your manager reads it at 5. He says, "You manage the risk correctly. You did not let it run. That is the job. You learned something that day that cannot be found in a textbook. The difference between managing a trade and managing risk is the difference between surviving and not surviving this business. Year 3, your profit and loss is $2.4 million. Your compensation, $415,000. You move to a larger apartment. You do not tell anyone how much you make. Level 4. The senior trader, age 32 to 38. Your book is $20 million. You have 2 junior traders working under you. You set their risk limits. You review their positions. You are responsible for their profit and loss as well as your own. Your base salary, $250,000 to $300,000. Your profit and loss split, 12% to 18% of profits. Total compensation in a strong year, $800,000 to $1 million, $400,000. You have survived 3 significant market events since you started trading your own book. The 2020 COVID volatility spike, a rate shock in 2022 that destroyed several volatility-focused funds, a liquidity crisis in 2023 that lasted 11 days and produced the most disorienting trading environment you have ever experienced. You did not blow up in any of them, not because you were smarter than the traders who did, because your position sizing was conservative when the market was expensive and aggressive when the market was cheap, because you followed your process when your instincts were telling you to abandon it. Your instincts have been wrong more often than your process. Marcus retired at the end of last year. He came to your desk on his last day and said, "The market will outlast all of us. Trade accordingly." You think about that every morning when you sit down. A hedge fund recruits you. $2 million guaranteed for 2 years. A larger book, more autonomy, higher upside. You take the meeting. The meeting is 3 hours. They show you the risk framework. They show you the profit and loss history of the desk. They show you the split structure. You counter on the guarantee. They come back. You sign. Level 5. The portfolio manager, age 38 to 44. Hedge fund. $35 million book. Your compensation structure. Base, $300,000. Performance allocation, 20% of net profits above an 8% hurdle. Strong year. Your book generates $7 million in profits above the hurdle. Your cut, $1,400,000. Total, $1,700,000. Exceptional year, $12 million above hurdle. Your cut, $2,400,000. Total, $2,700,000. You are no longer just trading. You are building a strategy, identifying market inefficiencies, constructing a portfolio that is internally consistent, where the positions fit together in a way that makes sense as a whole, not just as individual trades. You have a research analyst who works for you, a quantitative developer who builds execution infrastructure, a risk manager who reviews your book daily. You run a morning meeting at 7:45 a.m. every day. Your team, your framework, your process. The hedge fund has a loss limit on your book. 10% drawdown triggers a review. 15% drawdown reduces your capital. 20% drawdown closes your book. In year 2, you draw down 11% in 6 weeks during a period of extreme market dislocation. You are called into the CIO's office on a Tuesday morning. He looks at your positions for 40 minutes without speaking. Then he says, "Your thesis is intact. Your sizing is appropriate. Maintain." You go back to your desk. You maintain. 3 months later, the positions recover. Your year ends up 23% net. Your compensation, $2.1 million. You do not celebrate. You start preparing for next year. Level 6. The principal. Age 44 plus. $50 million book. 10 years of positive profit and loss. A track record that institutional allocators call before they call anyone else. Your compensation last year, $8.3 million. The year before, $5.1 million. The year before that, $11.2 million. The volatility in your personal income is higher than the volatility in most people's entire investment portfolios. You have made peace with this. The years when the market gives you nothing are the years you learn the most. You are now being approached about starting your own fund. The pitch, your track record, your process, your relationships. Seed capital from 2 family offices who have followed your career for 7 years. A prime brokerage relationship already in place. The ask, leave the guaranteed paycheck and build something with your name on it. You think about Marcus on his last day. You think about Kevin and his clean desk on Monday morning. You think about the post-it note that has been on every monitor you have ever owned for 14 years. Never size wrong. Never chase. Never let a bad trade become a disaster. You think about those 11 minutes when the pharmaceutical stock dropped 34%. You learn more in those 11 minutes than in any classroom, any training program, any book. You sign the term sheet for the new fund on a Wednesday afternoon. The fund launches in 90 days. Your name is on the door. Ending. You are 46. You walk into your new office at 6:15 a.m. Your junior analyst is already there. She is 23. She has been there since 5:45. She has 6 monitors on her desk. She is running a correlation matrix on a basket of positions you discussed yesterday. She does not look up when you walk in. She reminds you of someone. You sit down at your desk. You open your Bloomberg terminal. The market opens in 3 hours and 15 minutes. You start working. Somewhere on that correlation matrix, there is an error. She will find it, or you will ask her to find it. Either way, she will learn more from finding it than from anything else that happens today. The market does not care about your feelings. It only cares about your profit and loss. That was the whole trick. The Bureau of Labor Statistics estimates approximately 46,000 securities traders work in the United States. Of those who begin as junior traders at major financial institutions, fewer than 30% reach the level of senior trader or portfolio manager. The ones who last combine process with discipline and never mistake a good outcome for a good decision. That was the whole trick, not financial advice. All compensation figures based on publicly available industry surveys and reported data. Subscribe to The Climb every Saturday. One new level.